FORU ETF is designed for investors that are looking for a U.S. equity growth solution. The ETF dynamically adjusts to market conditions based on a set of quantitative signals and is designed to add moderate leverage when signals are strong for the potential growth, and will shift to a more defensive position when signals are weak, attempting to limit the downside. Another key feature is the management fee structure. There are no fees payable to the manager during months when the ETF return is negative. We think this is a fair way to do it. And there's a fossil fuel-free component. The core holding of the ETF is the SPDR S&P 500 Fossil Fuel Reserves-Free ETF. So there's a reduced fossil fuel exposure compared to broad markets. The FORU ETF tracks the ForAll Core and More US Equity Index and has three components to it. One is the core component, that's 20% of the portfolio. This is in the SPDR S&P 500 Fossil Fuel Reserves-Free ETF, and this part doesn't change. The second is the asset allocation component, that's 50% of the portfolio. This part dynamically allocates between gold and the S&P ETF based on a set of volatility and trend signals. And three is the alpha-seeking component, which is 30% of the portfolio. This part dynamically allocates between a 2x leveraged NASDAQ ETF and a volatility ETF, again based on a set of volatility and trend signals. So with these three components working together, the ETF can exist in one of three states. The first is an aggressive state that provides broad market exposure to US equities, essentially a combination of the S&P and the NASDAQ, with moderate leverage of 1.3 times. The index has historically been in this state 70% of the time when signals are strong and market volatility is low. Then when signals dictate, it will shift to a more moderate position by shifting away from equities, allocating 50% to gold, and 60% to the NASDAQ, and 20% to the S&P 500. Historically, the index has been in this state 28% of the time. Then there's a defensive position where it will allocate further away from equities and provide 20% exposure to the S&P 500, 50% exposure to gold, and 30% exposure to a volatility ETF. The index has been in this state 2% of the time, really during extreme scenarios like the COVID crash in 2020 or in June 2022 when inflation was getting out of control. We think if you're allocating to US equities, the FORU ETF makes a lot of sense for the potential upside you get from the moderate leverage, combined with the potential downside protection and diversification you get from the occasional allocation to gold. And again, there's no management fee payable to the ETF manager when returns are negative, which is another feature that will help reduce downside.